Welcome to Chapter 7 of the Fundamentals of Financial Accounting course. Before we proceed, I'll give you a minute to make sure that you have the notes downloaded from SFU Canvas, so you may fill them in as we proceed. Accounting Information System. A combination of personnel, records, and procedures that a business uses to meet its needs for financial data. The system collects information, processes it, and produces reports that meet the user's needs. An example of this is our use of a general journal and a general ledger. So we have some really active businesses out there with a lot of transactions. So the way we deal with heavy transaction load is through a couple of modern business strategies. One is computerization. Computers perform the counting functions more efficiently and reliably than humans. So anytime you have something that's repetitive and pretty straightforward, you want to automate that process because not only is it cheaper than having a person do it, it's also more reliable. Computers tend to make fewer errors than humans when it comes to basic repetitive tasks. Then we have specialization. Similar transactions are combined to speed up the process. So think of this as doing work in batches. When you have a batch of something, it's easier to process it all at once. So you'll see accounting systems out there posting entries in batches as it's more efficient than doing everything on its own. Some features of an effective accounting system. First and foremost, you want control. Internal controls safeguard assets and eliminate waste. These are essentially methods and procedures that enable owners or managers to exert control over their business. Some examples are company policies around authorizing transactions, detecting and reporting error or fraud, and limiting access to certain records or assets. Next, we have compatibility. A compatible system works smoothly with the business's operations, personnel, and organizational structure. Some large organizations have improved a number of processes by implementing enterprise resource planning systems, more commonly referred to as ERP. These systems not only facilitate the accounting process, but also connect organization branch, people, and processes to improve overall efficiency. Flexibility. A well-designed accounting system should accommodate changes as the organization evolves. A complete overhaul can be time-consuming, costly, and frustrating to people inside and outside the organization. Next, we have reports that meet the user's needs. An accounting system that allows its users to create special reports that best fit their needs is much more useful than a system that cannot be tailored to gather, sort, and present specific information. Favorable cost-benefit relationship. Managers strive for a system that provides the maximum benefits, some common ones listed above, for the minimum cost. Hence, an accounting system should be evaluated on a cost-benefit basis prior to being purchased and or implemented. Let's go into how accounting systems work. We have three stages of data processing. We have inputs. This will be any data. For example, if you think about the grocery store and the scanning of items which you will buy, that's input. That's information going into the computer system. Then you're processing. The computer takes the data and it puts it into the right boxes. So everything is organized in a readable and understandable fashion. And then you have output. So at the end of the day, if the grocery store wishes to run a report that breaks down everything that was bought throughout the day, as well as sales numbers, well, you can do that because the computer has the capability of producing the right output, which enhances decision making. Inputs, these originate from source documents such as orders received from customers, sales receipts, and bank deposit slips. Inputs are usually grouped by type. For example, a firm would enter cash sales separately from credit sales and purchases. Processing. This step includes journalizing transactions, posting to a general ledger, and preparing the financial statements. This process is time-consuming when done manually, but a computerized accounting system can quickly process data into reports or financial statements after receiving new information. And finally, outputs. These are essentially reports used by users for decision making. They can be specialized reports or simply financial statements. A trial balance is also considered an output in a computerized accounting system, even though it is more of a processing step in a manual system. Let's jump into special journals. So we will be working with the sales journal specifically in this chapter. In practice, it is inefficient and confusing to post all entries in the general journal, as we have been doing. In a manual accounting system, accountants separate types of transactions and post them into different special journals. Commonly, 5 transaction categories and special journals are used. So 1, we have sale of merchandise on account. This is posted in the sales journal, and the posting abbreviation is S. So you'll see that when you get referencing happening. So after you post information from the sales journal to somewhere else, you'll have a reference to S, which is a quick and easy way to reference back where the information came from. 2, cash receipt. So these are posted in the cash receipt journal, CR. Purchase on account, purchases journal, abbreviated P. Cash payment, the cash payment journal is abbreviated TP, and all others go in the general journal, abbreviated G. Transactions are recorded in either the general journal or the special journal, but not in both. So you'll only put one transaction in one area. You won't double post things anywhere. The sales journal. This journal is used when inventory is sold on account. These credit sales are usually posted separately from credit sales of other assets, buildings or equipment, which are recorded in the general journal. Let's have a look at how the sales journal for the SFU bookstore looks like. So here it is. Note the date. It's for the month of September. And we have invoice numbers, which are designed to keep track of the sales on account. And then we have customer accounts. We have the name of the customer, and we also have the customer's account number with us. The post ref column is checked off, when this information is posted elsewhere. So in this case, it will be posted as an AR balance in the AR subsidiary ledger. We're going to see that. And then we have journal entries. So it doesn't look like a journal entry, but you have all the necessary information here. We have a debit to accounts receivable and a credit to sales revenue. So that's the first half of any sale on account that we've journalized in this course. The second half is a debit to cost of goods sold and a credit to inventory, right? And I should also mention that we have the label up top. The special journal is called the sales journal, and we have a page number. You also want to keep track of that because it will be useful for referencing purposes. Note that the individual inventory sales made on account are tallied to produce a monthly total in the sales journal. As one may expect from a manual accounting system, these totals are posted to the general ledger at the end of the month. This doesn't have to be a monthly occurrence. An organization can decide when it wishes to post to the general ledger. Let's have a look at the general ledger now and post the September ending balances from the sales journal. Note the journal reference is S for sales journal, followed by the page number, which is 1. So I'm going to scroll down here so you can see how the general ledger looked like. We have these boxes, and each one of these boxes come from the journal entries up here. So 4 accounts used for 2 journal entries, 4 boxes. So the way this works is the posting is done at the end of the month. So at the end of the business day on September 30th, we will take our debit and credit balances from the sales journal and post them into a general ledger under the correct account and box where they belong. So you can kind of follow the arrows here, right? So for example, for accounts receivable, you see the arrow coming up from here. So the total is 700. You just follow the arrow and fill in 700. And then we also have a balance column at the end here. So after you post from the sales journal, you want to update the balances. So sometimes it will be a debit balance, sometimes it will be a credit balance. You want to do that correctly. So take a couple minutes and try this, and we will go over this exercise in the next video.